Coming to global economy, well, the OECD has lowered the forecast because of the tariff tension, and undoubtedly global growth is slowing down. Commodity prices have remained benign as growth is slowing down. The PMI continues to remain weak as there are concerns on the growth. Bond yields are moving in a volatile fashion. In US, Japan, bond yields have risen. In most of the European countries, bond yields have come down. So different countries, different paths are being used on the bond yield side. Despite all this uncertainty, global stocks are at all-time high level. MSCI World Indices is now at its previous high of February 25. If we come to China, there have been pro-growth measures in their economy. They are cutting down reserve requirements, keeping interest rates low, and pumping liquidity with the hope that Chinese economy gets reflated. However, their inflation continues to remain subdued. To some extent, China is trying to shift from investment to consumption. In 2009, consumption was about 36% of GDP and investment was 44% of GDP. After a lot of effort, consumption has now become 40% of GDP. Investment continues to lead at 41% of GDP. Undoubtedly, China will prefer to invest less and consume more. The other challenge for China continues to remain their overall debt to GDP ratio. It's almost touching near 300% between corporate, government, and household. The other economy, Japan, has started receiving investor interest, and inflows into Japanese bonds and stock has reached in the near term one of the highest level. Coming to US economy in particular, well, President Trump is trying to correct the imbalance. Americans are spending far more than what they are spending, hence need to control fiscal deficit. They are consuming far more than they are producing, hence need to control current account deficit. And with high fiscal deficit and high current account deficit, obviously debt to GDP ratio keeps climbing. US fiscal deficit has remained above 5% in last 5 years. And as the feud between Elon Musk and President Trump happened yesterday, it's all about the tax bill, which is likely to increase deficit further. As we speak, US debt is touching almost $37 trillion, and that's a scary number. More importantly, US depends upon rest of the world to fund its current account deficit. China, Germany, Japan, Korea, they are large suppliers of their savings into US for investment. As of today, decoding US policy is like finding out Pollock painting, fairly confusing. हिंदी फिल्म का एक डायलॉग है, डॉन को समझना मुश्किल ही नहीं, नामुमकिन भी है. That's applicable to current US policy. The market has coined a term for Trump always chickens out trade. Whatever Trump proposes, one day, other day he disposes. And this has resulted into too many ins and outs, back and forth on the policy making side. One of the reasons why US policy on tariff is back and forth, well, their experience suggests that whenever they have imposed broad-based tariff in 1828, in 1930, in 2025, by and large, it has resulted into recession at a later date. Hence, maybe they are doing flip-flop on policy so that recession can be avoided. Despite all the uncertainty on US economy, the liquidity provided by US Fed and the fiscal policy of the US government has resulted into earnings season turning out to be good for US equity. S&P 500 reported fairly strong results for March 25 quarter, and almost 78% of companies have reported above estimated earnings growth. Customs duty collection has risen because of the imposition of tariff, and the trade with China has come down dramatically because of imposition of tariff. On the other hand, US delinquency rate on auto, housing, mortgage, student, and credit card loans are rising. Somewhere it is a spike like the student loan and credit card. Somewhere it's a gradual reversal like in auto loans and housing loans. With all the uncertainty, market is worried about US government debt, and the credit risk premium on US government debt has started rising. Of course, it is significantly lower compared to its recent all-time high of 150 basis points. We believe eventually things will settle down. President Trump, after threatening allies as well as enemies, will come down to a level of tariff which will be reasonable. It will help US raise certain revenue, control some imports, and yet at the same time don't derail global growth. One of the reasons why we believe US tariff will be reasonable is the fact that a lot of Asian economies and other economies have pumped money into American assets. If we look at equity of America, 16.5% is owned by foreigners, almost similar to what foreigners own in India. On foreign direct investment, about $16 trillion is owned by foreigners. On the debt side, $15 trillion is owned by foreigners. Overall, foreigners own $57 trillion of American assets, and hence quite likely that US will have to take care of investors' reaction. Coming to Indian economy, headlines have been fantastic in terms of growth, in terms of inflation, in terms of rainfall. We achieved highest ever food grain production of 354 million ton in FY25. It's a growth of almost 6.5%, largely led by record production in rice and wheat. Thanks to the agriculture and tax collection, the fourth quarter GDP came at 7.4%, way ahead of street estimates. The overall recovery in the economy is fairly positive, with industry, services, agriculture, and manufacturing all contributing positively to fourth quarter growth. In this process, India has overtaken Japan to become fourth largest economy, and now our per capita income is about $2,900. In emerging market tracker, India continues to look better compared to peers. More importantly, the growth has been achieved with inclusiveness. Affordable housing has jumped from about 10 lakh to almost 4 crore plus. LPG coverage, household with tap water and electricity access, households with water sanitation, all have jumped significantly. So not only India has grown, it has also ensured inclusive growth. In terms of GST collection, FY25 overall GST collection growth was little lower than nominal GDP growth, but FY26 it has begun with a bang. Both April and May numbers have come well ahead of nominal GDP. There is visible signs of improvement in consumption activity, two-wheeler registration, rural consumer sentiment, tractor registration, all are indicating improvement in consumption activity. The water storage level is higher at this summer by about 22% over last year. This bodes well for coming monsoon season. Indian Meteorological Department has predicted above normal monsoon this year. This will again be supportive for Kharif and Rabi crop. The budget gave tax rebate of 1 lakh crore in the pockets of taxpayers. It's likely to benefit more than 5 million taxpayers. More importantly, this is recurring every year. This should support consumption in the days to come. Interest rates have come down by 1 percentage point. That puts about $10 to $12 billion in the pockets of consumer by way of lower EMI. As EMI burden comes down, people will probably spend this money on consumption. God has been kind to India. The crude prices have now hit 60 handle. The pump petrol prices are far higher than global crude prices. There are reasonable possibility that there will be petrol diesel price cuts. If that happens, it will again put more money in the pockets of consumers. Crude oil is Rahu and Ketu of our Kundli, and as crude comes down, there is substantial amount of savings to India in terms of FX payments as well as inflationary impact. This year, RBI will be paying 2,68,000 crore worth of dividend. That augurs well from the fiscal point of view and the ability of government to spend money. While there is money in the pockets of central government, the avenues to spend is coming under pressure. The road capex is stagnating around 2,65,000 crore for last 3 years. Same is true with railway capex, as many new trains and tracks have been added. As we speak, this day we have connected Jammu and Kashmir with India by constructing Chenab Bridge, which is one of the tallest in the world. Despite doing those kind of projects, the railway capex is tapering off. In some sense, the conundrum is central government has money, but not much avenues to spend. State government has a lot of avenues to spend, but they don't have much money. The private sector investment has remained subdued. It grew 7.6% in FY25. It's lower than nominal GDP growth. The bank credit growth has come down to low double digits, high single digit. This credit growth is also driven more by personal loans and retail loans and services. Industry as well as agriculture both have seen drop in the year-on-year credit growth rates. As credit is not picking up, it will be fair to assume that maybe investment will remain on back foot. On the manufacturing side, there are mixed signals. The diesel consumption has gone up, but port cargo movement has come down. Automobile production, two-wheeler saw recovery, but car production came down to low single digit. Overall, we are seeing Indian economy doing well to clock somewhere between 5 to 7% GDP growth. good monsoon, good global environment, GDP growth could be around 7%. Bad monsoon, bad global environment, we could come down to around 5%. But we are not taking enough steps, measures to go to double-digit growth. One of the worry for India is the drop in net foreign direct investment. The gross foreign direct investment has actually remained similar at $71 billion to increasing to $81 billion in FY25. But the outflow of foreign direct investment through divestment of companies like Hyundai and Whirlpool and so on and so forth has jumped from $41 billion to $49 billion. And outward FDI by Indians has jumped from $16 to $16 billion to $29 billion. Net, despite receiving $81 billion, net flow is just about $300 million. One factor which we should watch out on rupee is the record short position run by RBI in the forwards market. While our reserves are comfortable at $685 billion, RBI runs almost $80 billion short position in the forward market. Net reserves are somewhere around 585, 600 billion rather than reported figure of $685 billion. Coming to equity markets, clearly we have seen differential movement between countries where interest rates are coming down and where interest rates are rising. The Dow Jones or the US market return is negligible as interest rates have remained range bound. In the European market, as there was cut in interest rates, returns are fairly positive. Clearly, we are seeing a scenario where countries having loose monetary policy, the equity markets are rising. Countries which are having tight monetary policy, equity markets are correcting. Across the globe, despite tariff war, earnings seasons have come well ahead of expectation. Japanese market had seen large amount of outperformance in terms of earning expectation. China, Brazil, Mexico remain on the underperformance side. India also continued to deliver performance which was ahead of expectation. As Japanese interest rates have risen, 10-year Japanese yield crossing 1.5%, 30-year Japanese yield touching near 3%, the yen carry trade has reversed across the globe, and that will have impact on global asset class. Fortunately for India, we don't have much yen carry trade investment, and hopefully we will remain immune of this reversal. The market cap to GDP ratio at 122% is somewhere in the higher ranges, well above the historical range of 85%. However, the profit growth has been fantastic. Profits have almost quadrupled from 4 lakh crore to 18 lakh crore between FY20 to FY26. As profit grew by 350% on that base, market cap has grown by 276%. Undoubtedly, this profit growth does recommend or does suggest that there is no big correction ahead in the market. Valuation-wise, large, mid, small continues to trade at premium to historical average. But do remember that in Nifty, low PE stocks are going out and high PE stocks like Zomato and Jio Finance are entering, lifting their overall valuation. The small cap and mid cap does trade at a much higher premium to historical average compared to large cap. This is another chart to show how mid caps continue to trade at premium to large cap. The Nifty 50 index of out of the 50 results which have come so far, 15 have outperformed expectation, 22 are in line with expectation, and 13 are below expectation. Overall earnings growth has been fantastic. In the 297 universe tracked by Motilal Oswal Research, the PAT growth is about 9.6% above expectations. Within large cap, there was 9.7% profit growth for 86 companies, again above expectation. In the mid cap, profit growth came at 19.1% for 89 companies, again above expectation. If we remove one or two unique loss-making results like IndusInd Bank, this number improves further. Only in the small cap, there was expectation of earnings degrowth, and the results so far indicate that that is in line with expectation. Overall, 9.6% earnings growth is ahead of investors' expectation. FY25, the year gone by, Nifty 50 EPS is about 1015 rupees, earnings of about 250 rupees every quarter. Next year, it is expected that earnings will be about 1135, 12% earnings growth over FY25. Domestic institutional investors have been regular buyer thanks to all of you. They have built enough cash reserve to take on FPI selling. In the active mutual funds, cash balance is about 6%. And in the balance advantage fund asset allocation category, where in a falling market we can increase equity allocation, overall about 3 lakh crore is waiting to be invested in the market at domestic institutional investors. Last 5 years have been a dream run. More than 300 stocks have delivered more than 100% return in BSE 500. 177 stocks even today trade at more than 50 P. Undoubtedly, there are many good news, but that's discounted into the market. Overall, if we see the return, last 5 years return from Jan 20 to May 25 was 16%, led by small and mid cap of about 23%. 15 years before, overall return was about 11%, led by large and mid cap. If we look at 20-year return, overall returns are moderate at 12.5%. There is hardly any difference between large, mid, and small in terms of return. We believe going forward, please don't have this kind of unrealistic expectation. Please have moderate return expectation as markets are discounting almost all the positive news and are trading at very, very high valuation compared to peers. This is another way to anchor your return expectation. When you buy equity at low valuation, your returns are on the higher side. When you buy equity at high valuation, returns are on the lower side. We are trading somewhere here, and hence high single digit, low double digit kind of return will be appropriate to expect at this valuation. The markets obviously has lots of geopolitical and geoeconomical challenges. Trump साहब क्या करेंगे? No one knows. Foreign portfolio investors are coming in and going out. One day they are seller, other day they are buyer. Indo-Pak tensions has been buried for the time being, but who knows what happens next. The consumption, urban consumption is lagging behind rural consumption. There's expectation that thanks to the tax cut, EMI burden reducing, potential petrol diesel price cut, and 8th pay commission 2 years down the line could support consumption. The geopolitical risk between Russia, Ukraine, Israel, Hamas, China, Taiwan continues to fester. And most importantly, earnings growth are priced into Nifty at 25,000 level. What will happen to the foreigners' flow? Well, if you notice how emerging market performs vis-a-vis US market, there are phases. For example, 99 to 2010, for almost 11 years, emerging market outperformed US in this period. But from 2011 to 2024, US market has massively outperformed emerging market. Today, the divergence between emerging market and developed US market is in favor of emerging market. We believe at some point of time, foreign institutional investors will keep this divergence in mind to invest in emerging markets. FPI holding in India is now at a fairly low level of 16%. They are underweight India relative to India's weight in benchmark index. How much more underweight investors will prefer? In our opinion, there is a limited scope over there. Indian economy remains reasonably protected against sharp dollar depreciation. More importantly, corporate India, listed India is reasonably well protected against weakening dollar. DXY index has come down from 110 to 99, and clearly investors will look at resilience of India Inc. in falling dollar or USD weakness kind of market. While our economy has done well, the relative EPS growth of India, because of the strong earnings growth in last couple of years, is slowing down compared to other emerging market peers. We are likely to generate 10-11% earnings growth. Other markets are also likely to generate similar earnings growth. Another factor which we have to keep in mind while evaluating equity is the promoter exit. Both local and global companies are taking profit out by selling their holding in group companies, associate companies, or their own company. At this point of time, should we keep some dry powder to invest during correction? Answer is definitely yes. We remain overweight large cap as small and mid cap continues to trade at premium to historical average. This is fair value market. It's not cheap. It's not very expensive. And hence one can maintain neutral allocation to equity. Coming to equity per se, across majority of our fund, we continue to deliver outperformance over benchmark index. This is true in equity as well as hybrid funds on a rolling return basis. On a point-to-point basis, there are funds where we have underperformed benchmark index. However, our focus is to ensure that we bet on good companies rather than momentum companies. This is also true across other equity and hybrid funds where we have been able to outperform benchmark indices across most time periods. On the SIP side, barring few funds, we have been able to deliver better return than benchmark indices. Some of the funds which you should keep in mind recommending to your client is a large and mid-cap fund like Kotak Equity Opportunity, Contra Fund, or a multi-cap fund or a quant fund. These are the kind of products which will be suitable in today's market. Thematically, consumption and banking and financial services look attractive at current valuation. On the passive side, we have a bouquet of many low-cost funds across sector, theme, overseas, as well as market cap and smart beta base. At this point of time, our recommendation on passive market cap will be more large cap like Nifty 50, Nifty Next 50. In commodity, we prefer silver over gold from a short-term point of view and gold over silver over long-term point of view. Thematically, consumption and banking looks attractive. And if you want to invest into smart beta index or ETF, then Nifty top 10 equal weight index or Nifty 100 low volatility 30 index are worth considering. Coming to fixed income, US inflation has come down, but it continues to remain above Fed's target range of 2%. Fed fund futures are targeting 2 rate cuts till end of this year, that is CY 2025. The US and India 10-year yield gap has narrowed down substantially, but that is justifiable based on the narrowing of US and India inflation gap. When those gaps were wide, the treasury yield spreads were also wide. Today, when the spreads have come down, obviously there is case for treasury spreads to come down. As I mentioned before, Japanese 10-year bond yield is now touching 1.5% and 30-year is touching 3%. This could have implications in yen carry trade reversals. Inflation remains muted in India. RBI revised inflation target for next year from 4% to 3.7%. It shows that retail inflation is coming under control. RBI has been fairly active to support growth. They have cut policy rates, including today's 50 basis point by 100 basis point. The monetary policy stance was changed last policy to accommodative. Now it is reverted back to neutral. We believe there is a front loading of rate cut, and hence there will be now a lull in the rate cut now there will be a lull in future rate cuts. The RBI annual report is a treasure trove of data. You can all refer to this slide in terms of what are the pluses and minuses. The liquidity, which was in deficit during first half of current year, has now become positive, and the core liquidity between RBI OMO, US dollar swap, and RBI dividend and CRR cut could be roughly about 12 lakh crore liquidity infusion. Even if you remove some of the deficiency, the core liquidity is likely to be somewhere around 6 to 7 lakh crore. As our fiscal and monetary fundamentals have improved, we have started diverting from US Treasury. The gap between US Treasury and Indian Treasury is one of the narrowest in recent memory. Coming to fixed income investment opportunity, the best fund to consider for high tax paying consumer will be Kotak Income Plus Arbitrage Fund of Fund. After 2 years of investment in this fund, you will be entitled to tax rate of 12.5%, which is applicable for long-term capital gains. 12.5% tax rate for 2-year lock-in makes this one of the most attractive fund. It is the largest in its category, and anyone who has higher tax base is better off investing in this fund. Hybrid funds should be kept in mind by investors as interest rates have come down dramatically. And you can look at the kind of return our hybrid funds have generated over a period of time. Gold continues to shine. In fact, in last 2 years, including this year, the returns have been accelerating. The reason why gold continues to remain supportive is because supply of gold is limited relative to its holding. On the silver, there is little bit more potential supply. The central banks have been big buyers of gold, be it China, Russia, Poland, Turkey, India. Almost every central bank is looking to add to their gold holding. What we have heard, people believe there is also unhidden purchase. What we have seen is obviously the official purchase of central banks, but there are people who believe that many central banks buying has not yet been fully declared. Overall, gold share in global foreign exchange reserves is high for developed world and low for developing world. If India, China, Singapore, Ukraine, those countries starts moving their FX reserves into gold, that could really give support to gold prices in the days to come.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.